Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Wednesday, September 7th, 2022. And our top story today, flows to exchange-traded funds were steady during the recent market tumult. Joining me now to discuss this and a lot more, Sylvia Jablonski is with Defiance ET. Sylvia, thanks so much for joining us. We appreciate you coming back on the program this morning.
Hi, thank you so much for having me. Good morning and happy post-Labor Day weekend.
and perfect timing because we are the second day back from Labor Day weekend. And I want to start off with you're also the Chief Investment Officer for Defiance ETFs. And I want to get your perspective on where we've come in 2022 and then this last several months. What could we possibly expect, knowing that you're not going to give any financial advice on the program?
Yeah, absolutely. So, where we've come, I think 2022 is a rough year for most investors. We see all of the major averages well off of 52-week highs. S&P 500 and NASDAQ were in bear market territory and saw that rally in June. But, here we are again, starting September. With S&P rubbing up against it might be there, given the last couple of seconds of turnaround there, and NASDAQ, close to being down 30%. So, it looks like we're getting close to those June lows. I don't necessarily think that it's going to get, sort of worse than what we saw there, but remains to be seen. I mean, there are a lot of kind of interesting factors impacting the market right now. And the most notable factor, or the most talked about factor anyway, would be, Fed Chair Powell maintaining his resolution to fight inflation. And the market sort of knew that, right? A lot of that was already priced in, but it seems like the strength and the conviction behind his Jackson Hole speech, really sent a lot of traders for the sidelines, and we had this risk off environment where now we see the market having a tough time catching a bid. So look, like the sort of bad things happening in the market. You have this ongoing war with Ukraine and Russia. You have energy crisis in Europe, inflation, a potential recession in Europe because of all of this. You have, two negative quarters of GDP growth, which I guess is the technical definition of a recession in the U.S. And you have a Fed that is looking to tighten monetary policy in an unsteady market. On the other hand, so where are we now? We're in this period of sort of, panic, terrible consumer sentiment. I know Michigan looked a little bit better on the last read, but consumer sentiment was at all-time lows. And, I think you've seen this broad-based selling. I think we're in an oversold condition. And in terms of where we're going, I think that a lot of this is going to play out for a reversion towards a more bullish market going into the year end. I don't think we're going to have a double-digit growth in the coming years, but I do think that a lot of the indices will sort of revert and end up positive or at least kind of flat to the year. And the reason why is because I think inflation has peaked. A lot of people believe that, but it's actually coming down pretty fast now. If you look at the price of gasoline, price of oil, if you look at durables, if you look at housing, if you look at rental cars, if you look at airline tickets, some of these things are starting to really budge. And I think that that's going to play out in the next couple of reads, which Fed Chair Powell is, intensely going to be monitoring. So once he sees the data, that's going to be a positive thing. Jobs feel hot, but then the last jobs number, that 315,000, you can see that jobs are strong, but some of the wage growths are starting to wane a little bit. And, you've got a lot of people sort of off the bench and back into the job market. So that's another factor. And you keep hearing about all these massive layoffs by some of the largest companies in America that, are top leaders of the S&P 500. And that data is lagging too. So I think that once that starts to feed in, Fed Chair Powell is going to have a look and say, now we are, sort of inching up on slower growth, risk to the market, recession, and a lot of the data points show that things are coming down a little bit faster than expected. So I don't think we're going to get a pivot. I don't think that anything will happen. I think that there will be, a couple more rate hikes and perhaps it will embolden the Fed to sort of stop when that data comes out. But in the meantime, I don't look at the markets in terms of what's going to play out in the next 20 days. I have no idea. September is usually a terrible month. And for the sake of like the bad juju of September, I mean, that's kind of a joke, but there's a lot going on in the market. And, so in the short term, it's hard to sort of day trade and make those short-term transactions for the average retail trader. The high frequency guys, hedge fund guys are great at it, but retail traders, not so much. Impossible to time the market, but dollar cost averaging and looking at these opportunities to buy the stocks you like at cheaper prices is perfectly reasonable. And that's not necessarily financial advice, but it's the way that I think about things. I like to find stocks on sale and purchase them for the long run.
Yeah, and I like that you ended your talk about that, or not talk, but your comments about that, because long-term investing is where it's at for so many Americans. And in the context of what you just described, our friends at Morningstar, and they're not really my friends, but they put out data, ETFs, and we're talking about ETFs today, hauled in $43.8 billion of new money in August. And that's very consistent throughout the year. And so what do you take from that, Sylvia? I mean, people are still investing, and they're investing in ETFs with typically, not all, but typically trade based on indexes. They're baskets of stocks trading on indexes and things like that. So what do you take away from, it sounds like the ETF trading is going pretty well.
Yeah, what I take from that is that, ETFs have now been around for a while, and I think people are more comfortable with the vehicle than they ever were before. And there's been this great sort of replacement. You have, not to knock mutual funds, there are amazing mutual fund products out there, but ETFs have sort of come out and they've become the cheap, most efficient way to trade and get exposure to underlying indices or themes that an investor might want to get exposure to. So, it sort of makes sense, right? I think it's when you have this volatile market and each day, each company earnings are uncertain, the future and the outlook is uncertain. A lot of investors who are not sort of professional market watchers will say, you know what, the S&P 500 is down close to 20%. I'm going to buy an ETF and just hold it for a long time. And when this whole thing shakes out, I'm going to do quite well. So I think that ETFs are, sort of still here and still that great vehicle for doing that. In terms of the flows coming in, what's great about ETFs is that now I think that a lot of, retail traders, investors, professional traders are more aware of the different types of products out there that they can benefit from. So what I mean is that, the market's sort of crashing these days, or we're seeing sideways volatility. And you have short funds, right? So a lot of the high growth names, for example, are doing poorly. You can buy an ETF that shorts those names. You can buy a short ETF to hedge your position. If you're sort of tired of watching your portfolio go down in the short term, and it's a way to kind of protect your clients and whatnot. So using short, broad-based index funds. Direction has a bunch of them, ProShares has a bunch of them, to hedge portfolios is something that I think a lot of investors are looking to do. And there has been this great emergence of really, cool, innovative ideas, whether it's cryptocurrency products or, thematic types of plays like we offer. I think that investors have found a variety of products to trade, and even the anti-inflation types of ETFs, like the Nancy Davis's product and some of the Astoria Advisors ETF and things like that. Those are good products to look at in these types of markets. So I think that there's been a good time and a good place for some of those ETFs to pick up steam.
And they're accessible on virtually every platform, which I think is an important takeaway. Sylvia, I need to take a very quick break, and Sylvia mentioned some new products, one of which is the single stock ETF. I think you're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking this morning to Sylvia Jablonski of Defiance ETF. Sylvia, welcome back. Thanks so much for staying with us this morning.
Thanks for having me, Jack. Great to be here.
I'm so glad. I haven't chased a guest off yet, and so I'm really excited that streak, we're into over 1,000 shows, and I'm glad that streak has continued. Sylvia, GameStop, AMC, we all remember the meme stock trades, and there's a relatively new product, I guess, that's out, the single stock ETF. And I wanted to ask you first, what is this type of product, and how does it work?
Yeah. So, well, first, I'm glad that I haven't been the first person who's kicked off of your show. That's
not kicked off. Who just said I've had enough.
For somebody else.
Yeah, I'm just concerned. I don't like to chase people off. I want to do a good interview so people will stay. That was my point.
Yeah. No, for sure. Yeah. So the single stock ETF products are really interesting. You know, they're levered versions of a single stock. So, for example, Tesla is one of the more popular ones. So you have a bull and bear Tesla single stock ETF. On the bull side, you get 1.5 times exposure to the daily movement of Tesla. So for investors who are, super bullish on Tesla and they think that the stock is going to sort of trend upward, compounding and that extra leverage will benefit in their favor. So you're essentially adding some juice to your exposure and your investment in Tesla over time. So my thoughts on this are that I think it's great, and I think it's a great way to evolve the future of ETFs. So, for years, we sort of have relied on the 1940 Act fund, and it works great for your classic indices. But for different types of themes, kind of like pick one, whether it's cannabis or whether it's autonomous vehicles or, sort of anything, right? Psychedelics, 5G, whatever it is. There are rules, in terms of how many names an ETF has to hold and diversification rules and things like that. So, there aren't enough, for example, pure EV companies to just create an ETF that has only EV companies. So if you look at some of the popular ones out there, they have Tesla, they have Rivian, they have Ford, which arguably, doesn't generate most of their money from EV. They have NVIDIA and Honeywell in there, which, contribute to the build out of these products, but that's not really what people are looking for exposure to. So when you think about a product that has, a couple of names or a single stock name that is just leveraged to a theme, I think it's super attractive for traders and retail investors because you're actually getting pure thematic exposure to the exact stock that you want exposure to, or the few stocks that you want exposure to, and not necessarily the whole general universe that's related to it. So I think they're going to be a great complement to thematic investing.
Sylvia, everything in life has pros and cons. What are some of the pros? I think you mentioned some of the pros. What are some of the things that you need to think about if you're getting involved. So it's not, a lot of people made money during AMC and GameStop and the meme investing trades, but then there were a lot of people who didn't. So are there lessons that people got from those situations that apply here to single ETFs? And what should people know before they might consider investing, knowing that you're not giving any investment advice? Because I don't want you to get you in trouble with compliance and therefore chase you from the show.
Yeah, for sure. I think, you bring up a good point. So the number one issue, I think, is concentration risk, right? I think that, the ETF issuer is assuming that you're not only buying that one ETF and that's, your entire portfolio, but the benefit of having a diversified basket of a couple of names or, the classic ETF that I mentioned before that might have some of these other names is that you reduce your concentration risk. So if one name, if Elon Musk comes out and says, I hate Teslas now, and the stock comes crashing down, you're in a lot of trouble. You're in a lot of trouble if you have the bull fund, right? And there's sort of nothing else to buffer that. So concentration risk is number one. Number two is just understanding levered inverse ETF products. So I spent over a decade at a levered inverse ETF product shop. I know them super well. So trend is your friend. If the market is trending in either direction, whether you're a bull or a bear, you're going to benefit because compounding will essentially work in your favor as the ETF rebalances and increases exposure or reduces exposure to a particular index directionally. Where you get into trouble with these is if you have a market like we have now, where you have range bound volatility, meaning, Tesla's up 5% one day, down 5% the next day, up 5, down 5, that tends to lead to decay. And even if at the end of the month, let's say Tesla's up 10%, but every day in between, it's kind of, hinged up and down 2 to 3% ranges, you're likely to underperform 1.5 what Tesla did. You could be negative, you could be positive, and that's the real risk. So compounding in range-bound volatile markets tends to lead to investment decay. So, sort of proceed with caution and just understand that, you need to sort of have a conviction on two things. One, that the single stock is going to, move upward or downward. And number two, that you expect volatility to be sort of relatively stable and that you expect a trend to also occur during that time period. Otherwise, it's a little bit risky.
And that wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest curated news in lifestyle, wellness, finance, tech, so much more, all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content? We'll visit our website and, of course, our streaming partners. We're back again tomorrow for another edition of BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.